Let me start by clearing the fog immediately, because a lot of what we're seeing right now around silver is being framed in a way that makes it easy to dismiss. You're being told this is just another speculative pop, another emotional move, another headline-driven spike that will fade as soon as attention moves back to tech or crypto or whatever the next distraction is. That framing is comfortable. It lets people stay where they are. But comfort is usually the enemy of timing, and timing is what this entire conversation is actually about. What's happening in silver right now is not being driven by excitement, it's being driven by necessity. That's a critical distinction, and most people miss it because they've been trained to look at markets through sentiment instead of mechanics. Sentiment is loud, mechanics are quiet. And when mechanics start to dominate, price doesn't ask for permission. Before we go further, quick reality check, because this matters more than people admit. A massive percentage of you watching this right now have been here before. You've watched multiple videos, you've nodded along, and you still haven't subscribed. That tells the algorithm this kind of analysis isn't worth surfacing. So if you actually value breakdowns that go deeper than headlines, take 1 second and hit subscribe. Drop a short comment too. Even a simple phrase works. It signals that this audience is engaged and paying attention, and that matters more than you think. Now, here's the part that should already make you uncomfortable. When silver starts moving like this, mainstream coverage doesn't rush in to explain it. It hesitates, it redirects, it finds safer narratives. You'll hear about rate cuts, you'll hear about inflation expectations, you'll hear about anything except the one thing that actually matters, which is physical demand colliding with a supply structure that cannot respond quickly. That silence is not accidental. Silence is a strategy. Silver is one of those markets where the real stress never shows up where people are looking. It doesn't show up in flashy charts or trending tickers. It shows up in delivery schedules, procurement contracts, industrial usage forecasts, and hedging behavior. The people who need silver don't care about vibes. They care about whether the metal shows up on time and spec, at scale. And when that starts getting tight, the entire system behaves differently. A lot of people still want to believe this is retail driven, that it's forums and social media and emotional buying. Retail is involved, sure, but retail is not the engine. Retail is the spark. The engine is industrial demand and producer behavior, and those two things move slowly, then all at once. When they move, they don't reverse easily, because factories don't shut down just because price got uncomfortable. Here's something else that rarely gets talked about clearly. A large portion of silver supply is not mined because someone woke up and decided silver was attractive at these prices. It's mined as a byproduct. That means higher prices do not immediately translate into higher supply. You don't get a clean feedback loop. You get delay, friction, and eventually rationing through price. That ES when markets start doing things that look irrational in hindsight but are perfectly logical in the moment. Now layer that on top of what's happening in futures markets. Margin requirements are rising. Most people hear that and assume it's bearish because they've been conditioned to think higher margin equals forced selling. Sometimes that's true. But silver is not a purely speculative market when physical demand is real. Margin affects sellers too. It affects hedgers. It affects producers who normally provide forward supply. When it becomes more expensive to stay short, behavior changes. Hedging gets delayed. Supply offered into the future gets tighter. Not because metal disappeared, but because the financing math changed. This is where a lot of analysts get trapped. They look at silver through the lens of paper positioning while ignoring the fact that paper exists to serve the physical market, not the other way around. When the physical side gets stressed, paper mechanics start behaving in ways that confuse people who are only watching charts. Now let's talk about miners, because this is where frustration creeps in and people start making bad decisions. Silver moves, but miners lag. People assume something is broken. They assume the trade is wrong. They assume the market is telling them they missed it. But markets don't move in unison during regime shifts. They move in phases. Most retail investors are exhausted, financially and psychologically. The last decade trained people to buy the same things over and over again and be rewarded for it. Mega cap tech, index products, passive exposure. That conditioning doesn't unwind overnight. So even when silver starts signaling stress, capital doesn't immediately rotate into miners. Institutions don't move emotionally. They move defensively first, then opportunistically, then publicly. That's why miners can lag early. Capital is repositioning quietly. Risk is being reduced elsewhere. Short exposure is being managed. And only after that, groundwork is laid does accumulation start. By the time the narrative changes, positioning is already done. That's not conspiracy, that's process. And this is the part you need to really sit with. When miners finally move, they rarely move gently. They gap, they overshoot, they trigger FOMO. And the same people who ignored them suddenly claim it was obvious. That's how these cycles always work. There's also a psychological layer here that people don't like acknowledging. Attention is steered. Media incentives are real. Capital flows follow narratives, and narratives tend to support the structures that already dominate. Centralized platforms, scalable software, digital everything. Hard assets don't fit neatly into that story because hard assets introduce independence. And independence is uncomfortable for systems built on dependence. Silver sits in a strange place. It's monetary enough to challenge fiat narratives, but industrial enough that it can't be dismissed as a relic. That makes it awkward. Gold gets treated as a reserve asset. Silver gets treated like a problem that refuses to go away. And when silver tightens, it exposes fragility in places people assumed were stable. Now make this practical, because theory without application is useless. When you see silver rising and miners lagging, don't assume the miners are broken. Assume the rotation is incomplete. The crowd never rotates early. The crowd rotates when it's safe, when it's obvious, when the easy money's already gone. Early rotation is quiet. Late rotation is loud. Another thing people underestimate is substitution. In theory, higher prices should lead users to substitute away from silver. In practice, substitution is slow, expensive, and risky. It requires redesign, testing, certification, and trade-offs. Many manufacturers can't just swap materials on a whim. They have contracts, standards, and timelines. That makes physical demand sticky. When demand is sticky and supply is rigid, price becomes the only release valve. That's why silver doesn't move in smooth trends during stress. It moves in bursts. It overshoots. It creates charts that look fake until you understand the constraints underneath. And once those moves start, they don't wait for consensus. I'm not here to promise you a specific price. That's not how serious analysis works. What matters is understanding the conditions that allow for extreme outcomes. Rigid supply, urgent demand, financial structures under stress, those are the ingredients. When they align, markets behave badly in the best possible way for people who positioned early. Quick side note, because this matters if you're actually following closely. I share faster updates and short-form analysis off YouTube as well, because some things don't belong in a polished video. If you want those, the community link is in the description. That's where real-time thoughts go when things start moving quickly. Back to the core issue. Most portfolios today are built for continuation, not change. They assume the last decade repeats. They assume concentration equals safety. But concentration is fragile when regimes shift. And regimes always shift when people least expect it, because expectations are backward-looking by design. A lot of people are also simply tired. Inflation hurt. Volatility hurt. That stress makes people cling to familiarity. They don't explore new sectors. They wait for permission. But silver doesn't always give you time. When it moves, it compresses timelines. That's why it creates viral moments. Nothing spreads faster than a chart that looks like it broke the rules. If you're doing well, by the way, genuinely doing well, share one win in the comments. Doesn't matter if it's silver or something else. Other people read those. It matters more than you think. Here's another uncomfortable truth. When people buy individual mining stocks, they're making decisions. They're thinking. They're engaging with reality. When people buy broad baskets, they're outsourcing judgment. Outsourced judgment is easy to steer. That's why under-owned sectors can stay cheap longer than logic suggests. But they don't stay cheap forever when the underlying commodity tightens. By the time mainstream coverage feels safe talking about silver again, the easy part will already be over. That's always the case. Coverage arrives when it no longer helps early movers. That's not because journalists are evil. It's because incentives lag reality. So here's what I want you to think about. If physical demand is leading, if hedging behavior is being distorted by higher costs, and if the public is still crowded into old trades, then the next move in miners is unlikely to be polite. It's more likely to be sudden, and sudden moves don't reward hesitation. Answer this in the comments, because I'm genuinely curious how people are positioned mentally. Do you think miners catch up in a clean, steady trend, or do you think they catch up with a violent breakout that leaves late buyers chasing? And if you had to choose one for the next phase, physical silver, miners, or both, which would it be and why? One last thing before I wrap this. Pressure doesn't disappear because it's ignored. It accumulates. Silver is one of those markets where pressure can build quietly for a long time, then release all at once. Delays don't remove that pressure. They amplify it. If you want to stay ahead of that, instead of reacting to it, make sure you're subscribed. Join the community link for daily updates and check the members-only content if you want the deeper breakdowns that don't make it into public videos. By the time something feels obvious, the positioning window is usually closing.